welcome everyone to Financial Planning Does Matter. My name is Sam Tabbert. I'm your host for this segment. Today we have a very interesting guest. Damien from Van Dyke will be discussing with us fixed interest. Damien, thank you very much for being with us today in very interesting times. It's very critical that we do introduce our clients and our audience to different types of asset classes. So I was just wondering if you can give us a bit of a description about yourself, what you do at Van Dyke, and also we'll start with some questions around why is fixed interest, as we also know them as bonds, in the emerging market segment. So Damien, so just a bit of introduction about yourself.
Sure. Thanks, Sam. Thanks for having me on. So it's first recorded interview like this for me for the year. So for 2021. So I'm just hitting my straps. A bit about me. So I've been with Van Dyke for 6 years. My role is to take our ETF strategies to market. So it's a business development role. It's to work with financial advisors, stockbrokers. We're big advocates of financial advice. Most of our clients are advised clients, and so that's a very good thing. But my role is really to explain our different ETF strategies and how they fit in portfolios. Okay,
excellent. So in terms of fixed interest, what would be some characteristics or the country domicile for fixed interest investments in relation to emerging markets?
So the term emerging markets is, I guess, somewhat loosely defined. There's no prescriptive answer. When we talk about emerging markets, we're talking about a lot of the countries in say, Africa, Asia, South America, Eastern Europe. And obviously, when you start covering half the planet like that, a huge chunk of the population and lots of different countries, there's a lot of differences between them. But I guess the common threads between these types of countries that get put into that bucket of emerging markets is, firstly, relatively low per capita income levels. Secondly, like transitioning at a social, economic, political, and demographic level, and often they're actually associated with economies that are starting to really ramp up and see big increases in their level of foreign investment as they move from being, I guess, quite closed economies to open economies. So one of the key ones in there is certainly just the average kind of per capita income and in that area.
Okay, so over the last 20 years, have you seen some significant changes in this particular sector or regions and countries?
Absolutely. So if you think about emerging market bonds now to 20 years ago, so 20 years ago, it was an asset class that was very much associated with high levels of volatility. It was a very risky asset class. And when you ask like why that was the case, so the kind of key reason for that was really limited foreign reserves. So limited foreign currency reserves, and therefore a limited ability to absorb losses. And so when we talk about limited foreign reserves and why that's important now and why that was a problem then, you kind of think about bonds and borrowing. And so back 20 years ago, emerging market economies, they would borrow in US dollars. And so effectively, if their currencies weakened, that would increase their debt load. And if the debt load went up, what you would see would be increased default risk, foreign investors withdrawing, further weakness on the currency, and further increased debt load. And so in short, the picture I'm painting now is not a very good one. So it's not a very positive sort of scenario. And so as a result of this, it really set the scene for some very major structural reforms at an economic level and a policy level. And so what we've actually seen as a result in the years since then is an enormous increase in foreign reserves, and also a huge amount of the growth of the local currency bond market as well. So actually issuing bonds in their own currencies as well. So we very much of the view now that we're in a new world where some of the best managed economies are those in the so-called emerging markets. And even so, it's a little over a decade ago when the GFC happened. A lot of the emerging markets, they'd had those reforms. They came out of the GFC much healthier than the developed economies. It's seemingly happening this time around as well with the major economic dislocation due to COVID-19. And so our view is that'll probably take place again.
Okay. Now, as you're aware, the interest rates is probably at 100-year lows or very historical lows. So there are some challenges for investors to be able to generate a yield to cover their lifestyle requirements. So what are some risks, and how are investors now compensated if they do allocate some of their money towards fixed interest emerging market segment?
Yeah, it's certainly like gone are the days of being able to get a risk-free 5, 6, 7% yield. So that's alas not the case anymore. So to actually get a decent level of yield is associated, like you say, with additional risk. So emerging market bonds, like any bond, forget the label, the actual bond itself, the major risks are interest rates and credit risk. In terms of credit risk, I guess that's probably one of the important ones in emerging market bonds, because it's generally higher, the credit risk with emerging market bonds, than the developed world. The reason for that is because a bigger proportion of the emerging market bond world, or the emerging market world, is sub-investment grade credit quality as well. So that explains why there has been historically higher levels of volatility, larger drawdowns in that space. Another risk is currency risk. So like with, and this is in particular the case for emerging market local currency bonds. So if a currency moves, exchange rates go in one direction, it's a good thing. If it goes in the other direction, it's a bad thing. So that's a risk that investors need to be aware of. And a final, I guess, risk, and this isn't an exhaustive list, is idiosyncratic risks, so country-specific risks. And our view is in emerging markets, that is a little bit higher than in developed markets. And it's one of the reasons why we are big advocates for active management to avoid those sorts of countries as well. So that kind of covers a bit of the risk. I guess the second part to your question is on whether investors are compensated for it. We would contend they absolutely are.
You mentioned before about the risk. So how big is the sovereign risk in a given portfolio? With you mentioned you're obviously active fund manager, looking at the bottom line, the valuation of the particular bond and the country it's supporting that. So how big is the sovereign risk for most of those bonds?
So our view is that sovereign risk, like default risk, is somewhat overplayed. And it probably is a very backward-looking thing. So things, I guess, have changed. So like I said earlier, emerging market economies, by and large, are pretty well placed. So in aggregate, if you kind of look at fundamentals, way better growth rates, way less debt than the developed world. So that's a really good thing. And so we kind of think it is overplayed, the whole default risk in emerging markets. If you actually look, if you broaden it out and say, well, beyond just the governments, let's have a look at the corporates as well. If you take emerging market high yield bonds, so sub-investment grade corporates, and compare it to the universe of US high yield bonds, so US sub-investment grade corporates, what you find is over the last 10 years, default rates have been basically the same. Recovery rates have been basically the same. So we would kind of say there are misperceptions, there are a lot of myths. A big challenge when you put the term emerging markets in something is it does polarize. It conjures up images of risks, and a lot of which are somewhat unfounded, and a source of some of the, I guess, opportunities in the asset class as well.
The other thing I wanted to ask you, in terms of the risk return profile, when a client looks at their asset allocation of portfolio, how does the emerging markets fixed interest asset class compare to other asset classes?
Yep. So from how it has behaved in the past, you'd kind of say if you've got traditional bonds and cash over here from a volatility perspective, and equities here. Emerging market bonds have been somewhere in the middle in that regard. So that's kind of how we would classify it from a volatility perspective. If you're looking at risk from a volatility perspective,
Yep.
The comparisons to other asset classes, I think what's really useful there in thinking about emerging market bonds is, I think about the objectives of a lot of investors going into that asset class, and the key behind it is the income. Yeah. And so, like you said at the start, with interest rates basically at zero nearly everywhere around the world, anyone wanting a good level of income has had to almost push up the risk curve somewhat. Yeah. And so I guess for Australian investors, that has involved things like Australian equities with higher dividend yields. There is profound comfort in holding high yield credit. And so in terms of a relative measure, emerging market bonds have a similar level of yield to high yield credit and to say the Aussie equity dividend yield as well. Yeah. But the important thing is the volatility has been a lot less as well. So kind of say in that regard, the risk return compared to other strong yielding asset classes has been very, very strong, in that yield has been similar and volatility and drawdowns has been less.
Yeah. Okay. So in a nutshell, what would be the main reason that investors should invest in emerging markets fixed interest?
So broadly speaking, I'd say the first thing is relative to developed markets, emerging market fundamentals are really strong. So yeah, way better growth rates, way less debt. That's kind of point number one. Second point is you're getting paid for taking on the exposure as well. So the yields are higher. The risk is higher as well. We'd always make that point. But the yield is higher. In terms of the risks, like I said before, there are some myths in terms of, I wouldn't say myths in terms of drawdowns and volatility, but probably misinterpreted the level of those historical drawdowns and volatility, and somewhat of a surprise when investors actually say, oh, actually, during these huge market dislocations, emerging market bonds did actually hold up quite well during those kind of periods. And a final point, and this is kind of putting my portfolio construction cap on, emerging market bonds are a good diversifier in a portfolio. Yeah. And there's a lot of academic research that actually suggests that including emerging market bonds in a diversified portfolio does actually improve the risk and return characteristics of a portfolio over time.
Okay, so it does provide like a negative correlation to your traditional equities portfolio?
Yeah, so it's not necessarily a negative correlation, and correlations go up and down, but has had a fairly low correlation with other asset classes on average over time.
Yeah, excellent, wonderful. Okay, I think that's pretty much it, Damien. Look, thank you very much for being with us today. You've given us some good insights to our audience and our client base as well. And we appreciate you giving us the time. I know it's a new year, and I'm sure you're looking forward to hopefully a bit of a break from the last probably 12 months of economic activity and personal activity. But once again, we'd like to thank you very much for being with us. And again, just as a close, the information we provide today is of general nature. Any specific advice that we provide our clients, we obviously see them on an individual basis, provide personal advice. So this is general information to bring you, a very intimate financial literacy and understanding about how your portfolio, your current portfolio, or your future portfolio should be considered. Once again, thank you very much, Damien. I look forward to speaking to you hopefully another time, or maybe another asset class. We'll see how we go the next three to 6 months. But once again, thanks for coming in today.
Thanks for having me, Sam.
All right, thank you very much. Okay, we'll see you next segment as well. Thank you. There you go.